OptionChampion.com.
Today is Friday, August 19th. I'm Rick Adams, and this is Tricks of the Trade.
All data and other information contained throughout this video are for demonstration purposes only and shall not be construed as trading or investment advice or an advertisement for software or other trading applications, nor shall any part of this presentation be considered a recommendation of securities or other tradable products or related strategies. Trading and investing, whether short or long term, involve risks that may not be suitable for everyone. Any mention of past performance is not an indication nor a guarantee of future results, as volatile market conditions can arise at any time and result in substantial losses. No individual should make any trading or investment decisions without consulting a professional and conducting his or her own research.
Welcome to Tricks of the Trade on this option expiration Friday. Monthly options are now off the board for August, moving the September options up to the front month cycle. Another week means another round of economic data. Retail sales were unchanged for the month of July, missing the expected increase of 0.1%. June's increase of 1% was revised downward to 0.8%. Weekly jobless claims came in at 250,000, down 2,000 from the revised 252,000 in the prior week. The previous reading of 252,000 was revised downward from 262,000. Cash market indices were lower on the week. The Dow lost more than 54 1/3. The S&P 500 lost more than 51 3/4. The Nasdaq Composite lost about 342. The Russell lost 59, and volatility ticked higher by $1.07 on the week. Crude oil lost $1.86 on the week. Gold lost $58.60. Silver lost $1.87, and natural gas gained 50 cents on the week. In today's episode of Tricks of the Trade, we're going to deconstruct a collar strategy. A collar strategy is a three-leg position comprised of long stock, a short out-of-the-money call, and a long out-of-the-money put, with the stock price in between the strikes of the two options. The strategy essentially combines a covered call and a protective put, and if constructed properly, the two options can result in a credit that can reduce the cost of the long stock. Let's break the strategy apart and look at each side using our old friend XYZ stock. Let's assume that we bought XYZ stock for $44 per share and we want to write a covered call. We look at the option chain and see that a 45 call is priced at $1.42 with 30 days until expiration. So we sell the 45 call and receive a $1.42 credit up front. That $1.42 credit will be ours to keep as long as we keep the call option through the next 30 days until it expires. While writing covered calls can be a great way to collect premium, it also has a couple of disadvantages. First, a covered call has limited upside potential. Profits are limited to the difference between the strike price of the call option and the price paid for the stock, plus the premium received from selling the call option. For example, if we sell a 45 call on XYZ and the stock rises to $50 per share, and the call option buyer exercises the right to buy the stock for $45, which is the price guaranteed by the call option, then we will be obligated to sell our shares at $45 per share, even though the stock is priced at $50 in the open market. So if we had initially bought 100 shares of the stock for $44 per share, and later were obligated to sell those shares at $45 per share, our profit would be $100. But remember that we also received a $1.42 premium from selling the 45 call. Since the call option represents 100 shares of stock, that $1.42 is multiplied by 100, so we collected a premium of $142. Add that to the $100 profit from the stock, and our total profit would be $242. That's the most we would make on the covered call. It doesn't matter if the stock rises to $60, $65, $75, or even $100 per share. Our profit would be limited to $242. A second disadvantage to writing covered calls is that there is no downside protection. If we buy 100 shares of XYZ stock for $44 per share, we would have a total risk of $4,400. So let's say some terrible news comes out on XYZ and the stock falls 50% to $22 per share. We would have a loss of $2,200. There's nothing to secure a sell price and protect us from a significant loss in the event of a sharp decline in the stock price. So we buy a put option at the 42 strike price in the same expiration cycle as the call option with 30 days to go for $1.12. Buying the 42 put would lock in a sale price of $42 per share if the stock were to fall below that $42 strike price. So let's say again that we buy XYZ stock for $44 per share, some terrible news comes out, and the stock falls 50% to $22 per share. We would be able to exercise our 42 put option and sell our shares at $42 per share, even though the stock is priced at $22 in the open market. By buying the put option, we would secure a sale price as protection in the event of a significant move to the downside. Continuing with our example of buying 100 shares of the stock for $44 per share and the stock price falling below the 42 put strike, exercising the put at $42 per share would result in a loss of $200. But we also paid a premium of $1.12, or $112 in option terms, for the right to sell our shares at $42 per share. Factor in that $112 premium with a $200 loss on the stock, and our total loss would be $312. Now that $312 loss would be in a regular protective put situation. But remember, we're talking about a caller strategy where we also sold a call option at a $142 premium. So in that scenario of the declining stock price and exercising the 42 put for a $312 loss, the $142 call option premium would offset the loss and reduce it to $170. And lastly, in a final scenario, if the stock price remains between the two strike prices and each option expires worthless, the $1.12 premium paid to buy the put option would be lost, but offset by the $1.42 premium collected from selling the call option, resulting in an overall profit of 30 cents, and in turn, reducing the cost of the stock from $44 to $43.70 per share. That's it for this episode of Tricks of the Trade. I'm Rick Adams. Thank you very much for watching. See you next time.